Today we're covering offshore wind, and I work for a company called ENETI. I'm the head of corporate development and IR, and we're going to have a short presentation, but we install offshore wind turbines out at sea. That's one of our vessels, the Scylla. It's a WTIV, a wind turbine installation vessel, and that vessel will load turbine components at the marshalling harbor, sail out to the wind farm, jack up, install the components, jack down, and repeat that process. But rather than talk just about ENETI, I wanted to talk about the opportunity in offshore wind. This is the offshore wind capacity, annual capacity additions from Rystad, and they have the industry growing at a compound annual growth rate of 22%. And what you'll see here is capacity additions between 15 and 40 gigawatts per year. This is 4C Offshore's forecast. They have about a 17% compound annual growth rate through the end of the decade. They have 15 to 35 gigawatts of capacity added being each year through the decade. And I think what's interesting about this is in the bottom left, you can see the capacity that was added from 1990 to 2015. And each year through the end of the decade, more capacity will be added in a year than was added from 1990 to 2015. And this is Bloomberg. They go out a little bit further, but what you'll see here is also 15 to 40 gigawatts of capacity added each year. And the reason I bring this up is there's a lot of noise around offshore wind, but one thing is clear is that this build out is happening, it's significant, and the second part is that it's global. This was an interesting slide I got from Rystad, which shows that offshore wind CapEx could exceed offshore oil and gas by 2030. And whether that happens or not doesn't really matter. I think the important part is we're seeing CapEx increase from below $50 billion a year today up to 100 by 2030. And we are a very, very small, I know this is probably hard to see, but this is the overall CapEx of an offshore wind farm project. Turbine installation is only 2% of the overall CapEx. Very, very small piece, but you can't get power to the wind farm if you don't install the turbines. Part of the opportunity in this industry is that turbines have increased in size. That's helped drive down costs, increase output, efficiency, but also means they're going in deeper waters and they're heavier. The 12 megawatt turbines that are being installed today, this is the GE slide, are about the size of the Eiffel Tower. And so putting this all into perspective, we've got a massive order book of projects coming over the next decade, yet not enough available vessels to install these larger turbines. So this is the forecast for demand for 12 megawatt capable vessels is the blue line, and then the green is the demand for 12 megawatt projects. So the market is significantly undersupplied, and that's why we invested in the space. And up until December, we had said to our investors and to the market, given this undersupply, we expect a higher day rate for these assets. And in December, we were able to achieve on that. So we have a new building vessel delivering at the end of 2024, and when it's delivered, it'll go work on a project in 2025 for 60 to 73 million euros after project costs, which equates to 260,000 euros per day, or $280,000. Roughly 70 million in EBITDA on a $327 million asset is about a 21% cash-on-cash return. So the economics in this are quite good, but there are high barriers to entry. There's a lot of questions about this industry, and so we've got some great people up here, and I wanted to give our panelists a chance, and I prepared some questions for them. So Turner, we're going to start with you. Congratulations on your promotion from head of research to investment banking at Clarksons. As someone who has covered renewables as an analyst and now provides investment banking services to your clients, what gets you most excited about this industry?
Yeah, I think that's pretty clear, and you highlighted it in your presentation. I mean, it's the growth. Yeah, and I think the risk on that growth is obviously lower, just given that instead of sort of, I think in shipping, everyone's looking at future fuels debates, you're looking at regulatory risks. It's essentially the opposite. You have, there are, say, some regulatory issues, there's permitting issues to get through with regards to offshore wind, but I think it's an industry in very strong structural growth. It's also an industry that requires no subsidies. I mean, I think if you go back 3 or 4 or 5 years, if that's kind of where your knowledge is coming from, then that's way off. Offshore wind is is the world's fastest growing source of energy, and it's also requires no subsidies, right? So if you look at the cost levels for offshore wind, it's $50, $60, $70 per megawatt hour. I mean, that's at least in Europe, it's cheaper than gas, it's cheaper than coal, it's much cheaper than nuclear, and those costs have. We've seen a bit of inflation lately, but I mean, I think every industry has. So at the end of the day, it's something that is experiencing incredible secular growth, and it has very strong tailwinds. So I think that'd be the conclusion.
Oh, that's great. Thank you. All right. Well, Charlie's up next, and Charlie's been consulting the offshore wind industry for over a decade, specifically in the U.S. And I guess to start, what have you seen, and where are we today?
Thank you. Thank you for that. Well, the industry, I think, is in a very exciting moment. This summer is when turbines are actually being put in the water. Both at Vineyard, the 60-plus turbines at Vineyard, which are 13 megawatts, by the way, and the 12 at the South Fork project, which is off the eastern end of Long Island. That's an Ørsted project. The Vineyard is an Avangrid Copenhagen infrastructure project. If those projects go in the water smoothly, I think that's going to be a really good sign for the U.S. industry. If we have some hiccups, there'll be things that'll have to be addressed. But I think it's a tremendously exciting time. There's tenders all the time. The permitting process is moving by government standards, U.S. government standards at least, at lightning speed. The Obama administration is doing yeoman's work. But of course, we have a new election next year. We can have a new president in 2025. Everything could stop. Everything could accelerate. So there's those kind of background political aspects to be considered too. We can talk about it maybe in a little bit.
Sure. That's great. Thanks. And Ben, we've seen a lot of change in maritime coverage amongst banks. Some banks have stopped coverage. Some have trimmed areas, expanded into new areas. You cover rail, shipping, LNG infrastructure, and ENETI. ENETI is maritime. It's a little bit of engineering. It's a little bit of renewables. How do you see ENETI in this space, and what are your kind of initial thoughts after covering the sector for a year?
It's an interesting question because for me, ENETI, and for I think just about anybody in the U.S., ENETI is sort of a one-off. I mean, you could reach into the Danish market or other places to get a little bit more exposure, but increasingly there's a group of analysts on Wall Street that are focused on energy transition related things, and so in some places it fits there. And really, I think the name of the game is sort of aligning with where investors are at, and so I think it's to be determined, to be honest. For me, I think it's fantastic, and as Turner mentioned, it's nice to have exposure to an industry that has structural growth and isn't just purely cyclical. We'll see. But I would say that lends itself to growth. I think ultimately, as it relates to the U.S. investor base, it's still challenging to express an investment opinion just because there's just not. I mean, there's ENETI, and you could go to other markets, and away from that, it really gets tangential. And so there needs to be some further penetration within the capital markets in order for the sell side universe to be a little bit more clearly defined, I think.
That's great. Thanks, Ben. And then Turner, so given what Ben said, we're a one-off here in the States. There's a couple peers like us. these stocks trade pretty cheap. Discounts of 60 to 70% of their net asset value, sub 3 EBITDA in the current year, years later. So, how do we bank this sector? How do we grow these companies?
Yeah, it's a good question, and I'll echo what Ben said. So I'm a former sell-side analyst covering ENETI and also some of the Norwegian names. Yeah, I mean, it's a tough thing, right? To sort of place, and I think from its sort of capital and perspective, it's most similar to shipping. It's most similar to maybe offshore rigs, even though the demand factors are quite different. But it's very capital intensive, and it's got similar sort of a day rate OpEx kind of structure that I think shipping investors would find understandable and familiar. How do we? So what was the question about? How do we grow
these companies? So,
how do we grow the companies?
You're trading at a discount to NAV. You're trading at a cheap EBITDA.
Sure.
Investors like the story, but they say, look, you're too small.
So I think that's pretty simple, and I think that it's the answer lies with the developers, because at the end of the day, you're providing services, and you showed the CapEx split, right? Like right. If you go back to that. Yeah, look, your turbine installation, 2% of their overall CapEx of an offshore wind farm, right? Like it's very small, but the bottom line is that without one of these assets like NETI operates, you don't get the turbines in the water. There's no other way to do it. You're going to lift them in place with a helicopter, something the size of the Eiffel Tower. You need one of these ships. And so ultimately the responsibility lies with, the big utilities. It could be Equinor, it could be Ørsted, it could be Copenhagen Infrastructure Partners, Fangrid, Dominion Energy in the U.S. And I mean, I think the good news on that is so I guess to sort of nail that down, what they need to do is provide long-term contracts, right? You need to be able to stretch the visibilities of these companies so that, we can take down the cost of capital, we can see a higher valuation. I think visibility is key to that, and the only way for that to happen is for the developers to step in and start doing something. And we see some evidence of that happening, what you might call a more sort of proactive approach from the big developers to come in and give long-term contracts, even do it against new builds. We've seen in the U.S., Maersk Supply, for example, has gotten a long-term contract 4 years for an asset that's specifically built for the U.S. There's rumors they're going to get a second one. And Dominion came in and built their own asset, right? A little bit of a one-off special situation. But I've seen just recently these big developers starting to put capital directly into some of their suppliers. Because, again, without these suppliers, turbines aren't going in the water and they're not making money. So I think that the owners of the wind farms need to wake up to the importance of this and realize that if they don't provide that visibility, then the cost of capital is going to be too high.
A lot of good points. One of which I want to actually expand on with Charlie. The U.S., 30 gigawatts by 2030. I guess it would be helpful to hear what you're seeing.
Happen?
Yeah,
No.
Is it going to happen?
No.
How do we get close? Or
I don't know the exact stat, but it's something like you have to install 2 or 3 turbines a day starting today through 2030 to get to that number, and it's over 2,100 turbines. It's not going to happen. Is a lot going to happen? Yes, a lot's going to happen. And by the way, on the Dominion vessel, I think the jury's still out on whether that was a wise thing to do. Keppel has had trouble delivering the 2 container vessels for Pasha that preceded this vessel. There's reportedly a significant cost overrun, and it's definitely been delayed in terms of its delivery date. And in fact, it's not going to install the project it was originally designed for, which is the Coastal Virginia project.
And so we wind back, in case some are new, we've got this Jones Act. How does it apply to offshore wind?
What is the Jones Act?
How do we work through the Jones Act in this offshore wind development in the U.S.?
Well, it's being worked through. I think the Jones Act is a good thing for the industry, and the reason is it reserved at least some of the market for U.S. flag vessels, and which is important for the political stability of the whole program and the ability of Americans to think they have a stake in this. Because if everything had been done by a European vessel, including the O&M part of the business, not just installation, then you get even more of a problem with, as it is, which is European developers developing the U.S. market, which is the way it is today. The only one not European is Dominion. Every other entity is a European-based entity. So to me, the Jones Act, the fact that it at least reserves some of the market to qualified U.S. flag vessels is a good thing. The industry should think that. But at the same time, it causes a lot of angst because, and for example, you can bring in a foreign WTIV, but you can't use it to do everything you want it to do. Right. So those sorts of things are still being sorted out.
So there is a law, the Jones Act, that you're aware of, so you can go the Dominion route and build a vessel, a WTIV in the U.S., which can go to the port, load the components, install the turbines, or this feeder barge solution, which requires bringing in a foreign flag vessel, like a Maersk vessel or a NETI vessel to do these installations. But I think Turner brought it up, and I want to build on it a little bit more, is these contracts are short. So if you look at the first employment contract on our new build, it's about 9 months. So the contracts range from 9 to 12 months. And Turner highlighted how longer duration contracts would be beneficial for the industry, definitely in terms of visibility and cash flow. But, you know, Ben, you cover NETI, and we've announced some of these contracts. I guess, how would your what is your current valuation method when you look at a NETI, and then would these longer term contracts change how you looked at the valuation?
Yeah, well, I mean, we use a DCF basically because, and again, the DCF has a lot of variability in it as a function of, we know some of the contracts, but they don't go out very long, as you mentioned. And, you know, we don't, I mean, you could theoretically use something like NAV, but there's just a handful of assets in the market, so your price discovery is pretty poor. As a function of that, again, you just basically have to rely on the cash flows, and when the cash flows only have a couple of years worth of visibility, I can completely understand how an investor might not be incredibly comfortable putting a high multiple on, you know, cash flows that have a lot of variability. So at the end of the day, though, I think where we're getting, and as we've talked about, is there will have to be longer duration contracts. Heretofore, the industry just wasn't structured that way, and it is a little bit different in the United States. But you know, I think we're getting to the point where, again, as a company like yours is able to get a 9-month contract that is materially higher than what it was before, and as Turner said, as the cost for the developers creeps higher and higher, even though it's just on a small part of the overall cost basis, there is a tendency for longer duration contracts. But I think the more important part of that is even if costs were to go up, let's say rates were to go up by 50%, it's still, you know, just a couple percent of the overall piece of the pie. The bigger challenge is you have to make sure that you have it, because you can do all of the rest of the work, you can order your turbines and everything else, and if something goes wrong, or you're developing, as you guys ran into in China, or actually your developer ran into in China, if things don't go exactly as planned, well, you're not going to finish your project. And if you don't finish your project, and if you wait 2 years or however long it is before you can get another piece of equipment, that's a huge cost overrun. It's not just paying a little bit more for a vessel. And so I think that's going to be the catalyst that generates longer-term contracts, in combination with the fact that I think you are seeing a lot more developers come into the market. So there's a greater degree of competition for the equipment of the various types. And at the same time, the cost of getting it wrong is devastating. And so I think that will very much lend itself to longer durations.
That's great. And to clarify, so if a NETI is late for a project, we would be liable for that cost. However, if the project is delayed, we will still be compensated close to the full amount, or the project is extended. So I guess we've got this opportunity, right? Because the turbines got so large that the current fleet couldn't supply the vessels. And at what point, Turner, I mean, we could handle 3 to 4 to 5 more vessels for these larger 12 megawatt turbine vessels in the market. I think it was Vestas came out and said, we're gonna pause at 15 megawatts, at least now for the foreseeable future. Turner, you've covered the space for a while, and I'm sure you've heard that before. Does this make sense to you? Do you agree with this?
Yeah, I mean, I think that the turbine makers are also incentivized to pause in some ways. So the issue is that these turbines are just getting so incredibly big that they're in physical dimensions outgrowing their supply chain, right? Like they have to move all their factories to build these turbines to the coast so they can actually get the blades and move them to the offshore wind farm. I mean, these blades are the size of a football field or larger now, right? I mean, the nacelles, the gearbox, essentially transmission where you're generating the power, they're over 1,000 tons, and these things like the size of a large house, right? Like everything is getting so big that vessels that were even built, 5, 6, 7 years ago are starting to look obsolete because they were built to lift a turbine that's half the size, right? And that creates all sorts of inefficiencies. But the turbine makers themselves, I think they've spent hundreds of millions of dollars, if not more, on developing these models that they have now, the kind of 12 to 18 megawatt, somewhere in that range, and I think that they want to pay back on that. So everybody just needs to just chill out. We have very competitive prices where we are now, and there's no point of really pushing it further. But I just wanted to add on one thing that Ben said that I think is critical for investors to understand and think about is it's about, improving the valuation here is about lowering the cost of capital, right? And we talked about long-term contracts as one way to do that, right? So if you have much more visibility, then your cost of capital is going to be lower. But then I think another component of that is going to be having more assets, right? Having a bigger market cap, having more liquidity in the stock, right? Like all these things are risk factors that I think are leading to punitive cost of capital for some of the companies in the space, including ENETI. And I think some of them are going to be naturally worked out, right? The supply and demand balance is going to push the developers to be more active and give long-term contracts. We've seen that Cadler has gotten contracts that run out to 2030 and new builds, which are built against long-term contracts. So it's starting to happen there. And then, of course, we're growing the asset base. You have 2 new builds that are under construction, and that's not only going to sort of increase your earnings pool, but it's also going to reduce the operating leverage to any individual asset, right? I mean, we're talking now you have essentially 5 ships, right? If it were tankers or dry bulk company with 5 ships, it'd be very small.
Right.
Very, very small. So I think that natural growth that we're going to see in the industry is going to help address the size of the market cap, which should increase the liquidity in the stock. And I think that the market is going to solve the long-term contract situation and bring down the cost of capital and increase valuation.
It's even worse with cable layers. I mean, with the cable layers in the world that can handle export cable for long distances. In other words, wind farms pretty far out or connecting islands and the like, is 4. There's 4 of them today. And they're owned by 2 companies, Prysmian and Nexus.
That's interesting. And then, so focusing on the U.S., Charlie, I mean, we've got the one Dominion vessel, and we've got a bunch of foreign flag vessels that will have to assist in this process. Where are we in terms of who's building feeder barges? Are there going to be enough of those? I've got a lot of U.S. questions for you, but I just wanted to start there.
Companies are building crew transfer vessels, and companies are building service operation vessels. The CTVs and SOVs are the O&M side of the business. In other words, not entirely. You need a CTV to hang around, to move people around for the install phase as well. For purposes of the audience, I mean, a crew transfer vessel is a usually preferred aluminum catamaran, fast, stable, nudges right up to the base of the wind farm, the tower. The crew leaves, does its servicing job, comes back, and that vessel goes back and forth every day. If the wind farm is too far out, 20 miles, that becomes impractical because you spend half the day beating up your crew going in and out, and they don't have a lot of time on station. So the alternative model is an SOV, which is an expensive vessel. The CTV's a US 10, 12 million. An SOV is 80 million, maybe 100 in the US, 30 in elsewhere. So that vessel is a substantial vessel. It goes out for 14 days, stays on station, has a walk-to-work system. As I said, stays out there for 14 days. Excellent seakeeping, excellent habitation, a pool, a gym, a theater, excellent food, that kind of thing. Those are the two models. Those are being built in the United States. Feeder barges, not so much. At least so far, people think they can deal with putting motion compensation on deck barges. Eventually, there's not going to be enough powerful tugs, definitely for the West Coast. I think that's kind of the market at the moment.
Okay. But one thing that the U.S. So I wanted to add on. One thing you said is that the Jones Act is a good thing for the U.S. build out of offshore wind to sort of keep the sort of political support. Another aspect of that, I think you could say, is that it's forcing a new technical solution for offshore wind, which I think ultimately could lead to the costs coming down even further and gaining more efficiency. So, I mean, I think you understand, you showed the Skilla, right? Like, showed one of your vessels. So that's both an installation vessel with the big crane, right? But it's also got this big deck on there, which is used to transport, right? See? So you're transporting the turbines out and installing them with the same vessel. Well, because you're not allowed to transport and install in the U.S. with the same ship, because that's coastwise trade and not allowed under the Jones Act unless it's a U.S.-built vessel, what the solution that Maersk, for example, has come up with is basically taking a barge that you can, drop down the middle of that deck and lift it up out of the water, right? So that you can actually do the transportation with a much cheaper vessel, and then you can use the very expensive vessel. In the international world, this is $350, $400 million for this asset, and a barge is relatively cheap, right? I don't know, 25 million, 50 million bucks. I mean, the motion compensated would be a different thing.
Since we represent Kirby, I'm not going to comment on the 25 to 50 million.
You
can take my implication.
It's order of magnitude cheaper than this, right? So you end up with a situation just like you have in offshore drilling, where you have the expensive offshore rig, which stays on the field. It does its highest and best purpose, which is drilling. In this case, it would be installing turbines, and you have a much cheaper supply vessel running back with the components. So I think that we wouldn't have tried that outside of the U.S. You wouldn't try that in Europe because it's seen as a bit risky and you have to build new vessels to do it. But we see that happening with Maersk. Havfram is now building at least one, maybe two of those type of assets. So we'll see if there's a paradigm shift because of that. But without the Jones Act, it wouldn't have happened.
That's all true.
Paradigm shift. All right. Well, look, that's pretty interesting. If what Turner's referring to is the Maersk vessel is basically shaped like a horseshoe, so that vessel can go inside, and it actually looks to be quite interesting. Although it's a completely new design, I think they're the only ones doing it, and new designs certainly have their own risk, but obviously Maersk is probably the best to do it. Back to the U.S., let's say we get all the assets, the cable layers, the vessels. We're going to be able to crew the, how is that going to work? Because
you mean the vessels that have to be U.S. flag?
U.S. flag.
Yeah, I don't really think that's going to be overwhelming problem. I mean, obviously, a crew transfer vessel, you have a crew of two on shore, 2 on, 4 people. I mean, you're not talking about a lot of people. An SOV, you need more people. All the other vessels are foreign, pretty much.
Okay.
I mean, your maybe survey vessel, your standby vessels, those kind of vessels might be U.S. flag. So I don't think crewing is really the issue in the U.S. There is a problem. There's probably not enough aluminum shipyards in the United States, shipyards that can deal with aluminum. So there will be some bottleneck there for crew transfer vessels. You need, I don't know, Clarksons has said 130 of them. I don't know. There's 5 of them now, 8 being built.
Just a few more. All right. Well, I guess so. Then how do we do this, right? It all comes down to what you're earning. So prior to our contract, Turner, the market was around $200,000 a day for a new build WTIV of what that vessel could earn over a year. We paid $330 million for our asset, but if we went back to DSME in Korea today, probably could be about $400 million. We've got $280,000 on the new contract, but when we look at the economics, there's not enough vessels. Rates need to go up, especially if you were to go out and order a new ship today. I mean, do you see that happening?
Yeah, I mean, the thing is that these are small companies, right? The publicly listed companies are pretty small, right? We're all talking sub-$1 billion companies. And so when you talk about a $350 million new build vessel, like, it's the size of the market cap, right? Like, it's huge. And so to ask these like companies that don't have huge market caps to lift huge investments, it's got to be done with visibility, right? Like, I think, you all moved very quickly at the right time of the cycle before we saw new build prices really take off. And so I think that's played out very well, and you now get a contract on the first of two. But I think given where new build prices are and given the size of the market caps of these companies, you're going to have to have long-term contracts. And I think that the industry is beginning to understand that. And as I said, there's some examples of it that have happened. And I think, you referenced the rates. They have gone up a lot, maybe 50%. I think, and it depends on what kind of vessel you're talking about, but you're probably talking sub 5-year paybacks on the EBITDA versus the CapEx now. I think, and in some cases, maybe 3. So in that range, and even with tanker rates being where they are, I don't know, Ben, maybe you've thought about payback on a new build tanker now. What is it, like 7, 8, 9 years?
Go ahead.
I was just trying to think about it, and it's probably closer to that, even with VLCC at $50,000 a day, and new builds 120 plus.
Yeah,
it's like 8-year payback or something,
yeah.
Right? So like I think that there are some technicalities. There's a bit more risk in this space because it's installation, it's less sort of transportation, but still, the economics are compelling for an owner. And the barriers to entry are real because, to use a more local landmark, the Chrysler Building. We're not in Europe, James. We're in New York City. The Chrysler Building is the size of a turbine these days. And you're going to put 100 of them out offshore, in a windy environment. Like, that's hard to do. It's not like everybody just stepping in to do that, right? Okay, Maersk, right? Well, Maersk is the world's largest shipping company, so they'll figure it out. But I think for most, that's not going to be so easy. Economics are compelling, and I think the customers are incentivized to do things that are in your favor. So I think that's a good setup.
I think, just to jump in there, Turner, I think that is the barriers to entry are a lot higher than people think. People, especially if you approach it from a traditional shipping perspective, where if you just throw enough money at something, then you can have it. James, you and I on last Tuesday were on the Scylla in Amsterdam.
Yes.
As you go see one of these things and you talk to the people that operate the cranes, it's fascinating. Given the wind, given the waves, one of these cranes is trying to install in a very small several millimeter size space, these skyscraper level turbines. All the while, the crane is moving because of the wind and the current. It's moving in a figure-8 pattern. And so you have the crane operator has to match or mirror within millimeters the same movement of the turbine as it's up there being impacted by the blades. Like, there are literally only a few people in the world capable of doing that right now.
And it's 400 or 500 feet high, right?
Yeah, I mean it's nuts, and so at the same time that's just part of it. Like you have to sink the legs, and they have to be perfectly synced so that it's not unstable while you're lifting these massive amounts of weight. I mean, it's an incredible engineering feat, and I think that the real challenge going forward is probably going to be finding the right people that can do this, or training the right people I mean, if we're talking about a 20% CAGR, I mean, that's a lot of growth in a relatively short period of time where there is virtually no industry or very, very little industry knowledge as it stands right now. And you can't just take somebody off of a jack-up drilling rig and do this. It's a different skill set.
It is, and when we invested in the space, we had ordered an asset first before we acquired CJAX, and we had looked at building out our own commercial and technical team. But as Ben pointed out, I mean, this is a very engineering type business that is not, buying some dry bulk or buying some tankers and putting them in a pool. And we were very lucky to acquire CJAX. They had a great track record, great management, good assets, and so we had to acquire CJAX. You saw it with Subsea 7, you saw it with Cattler, but it's very hard to do, which brings me to my next question, because there's two things, as we've talked about, is there's high barriers to entry in this industry. There's also not a lot of private equity up until recently, and that has to do with the short duration nature of the contract. So Turner, Holm,
Yeah.
they are kind of the new person or team to the party, although they've been around for a while working on this new build. But they've had a new build on order for a while, but they were able to actually order that vessel, and they're private equity backed.
Yeah.
So, are we going to see more of that? Is that one off?
Well, I think Offshore is a bit special because the management team was the previous management team of one of the incumbent players. So they basically all just got up and left and started a new company. I mean, that can't happen so many times. So I think Offshore has a credibility to be able to do this because their management team, they've been doing this for a very long time. So for the management team, Fred Olsen Wind Carrier. Will we see more private equity come into offshore wind? Yes. Havfram is backed by Sandbrook Capital. They have one asset on order, and they may have a second one soon. I mean, I think it's possible, but I don't. To be honest, I see private equity in offshore wind a lot, right, on the development side and various things, but on the installation vessels, I mean, you got to think about it, right? Like I said, it's a $350 million ticket for one asset. I mean, even for most private equities, it's pretty big. I mean, it's $700 million in capex for two ships.
Sounds familiar.
I mean, it's tough, right? Like to get that through the investment, because if one asset and $350 million, your case becomes binary.
Right. And today, if we went back to DSME, the delivery date's probably 2027.
Yeah.
So, it's hard enough with investors today telling them this contract's going to start in 2025. I know we're running out of time, so I wanted to open it up for questions if anybody had. Yes.
Great. So question for Charlie. With the crane cargo swinging the way it does in broad figure 8 patterns.
You think there might be accidents?
No,
Room for lawyers?
Is there a Jones Act violation if it's not done by a U.S. vessel?
No. The transportation has to occur by vessel, not by crane. Come on, Jovi, you can do better than that.
The other question, on a more serious note, is given the relative proximity of these vessels to the U.S., are there any challenges or any improvements in the access of the mariners, especially foreign mariners working those vessels, to more easily come into the U.S.?
Only practical barriers, not real genuine legal barriers, in the sense of how long it takes to get a visa. There's a special visa for this kind of.
For mariners, does that improve at all?
Well, there's a special visa for people working offshore that's developed for the Gulf, the OCS visa, the Outer Continental Shelf visa, OCS-1. It just takes a while to get it. You just show employment in a U.S. consulate abroad, but it's all backlogged. That's the only problem.
And it's mostly British and Danish and Germans, right? It's a little bit different setup for crew, right?
Yeah, within reason. I mean, I was going to comment before. There's a reason why all of the U.S. turbines are being installed by so far 4 companies: Boskalis, Van Oord, Jan de Nul, and Deme. Does that surprise anyone? The two big Belgian companies and 2 big Dutch companies, all of whom have installed lots of them. I mean, the developers prefer somebody with experience. Price is important, but they prefer somebody with experience.
Any?
Yeah, a question about power purchase agreements that were concluded in some cases as much as 5 years ago with regulated state utilities, and how that's, putting a downdraft on the ability to reach contracts that are actually going to be in the money, given the cost, the ever-increasing cost of these units across the board, whether they're SOVs or TIVs or transfer vessels.
I can touch on that if you like. I mean, I think it's a broader issue for anyone who has signed a contract a couple of years ago and, looking to execute it now, whether it's an offshore wind or otherwise. Because if you look at the cost of the turbines, they're up about 30% since pre-COVID, right? And the cost of the turbines, I mean, they had it up there, but it's about 40, 50% or something in the CapEx. It's by far the biggest piece. So that's the main piece of inflation, although there is other parts of it. The broad trend, if you kind of take a step back, is that, like, if you look at the rounds, the sort of auction rounds where people basically give you a price, you basically bid in a price for a power purchase agreement. We're going to produce power from wind farms. You bid them into a state round or a national round or whatever it is. In the UK, I mean, going back to 2015, 2016, we were talking close to $200 per megawatt hour, and now we're looking at, maybe 70 in the US. It's high, a little bit lower in Europe, maybe 50. Because it's a more developed market. But yeah, I mean, it's a tricky thing, right? Because now you had a power purchase agreement with the state regulated utility. You go through the utility board, and suddenly the price that you had bid in a couple years ago doesn't make sense anymore, right? It's not way off, but it's off enough to where it may not be economic. You might be willing to eat that if you're a big developer and you have big plans in the U.S., but mostly you want to sort of hold back. So what we're seeing now is that in one of the projects in the U.S., they're pulling out, even though they have an agreement. This is in Massachusetts, and coming into a new bid rounds because these bid rounds roll. And I'm not an expert on that, but I think that these things will get resolved because it is in the interest of these states. This is green power. Yeah, it's local power. In many cases, it's among the cheapest, if not the cheapest, source of new power for that state. And so, while there are certainly legal barriers, and I'm no expert on that, I think that at the end of the day, the economics will determine that there may be some delay, 6 months or a year, perhaps. But ultimately, these projects are going to get built because they make good economic sense.
Thank you very much. We've hit our time. Thank you, Turner, Ben, and Charlie. We appreciate it.
Our pleasure.